Every dollar in your wallet was created out of thin air, and someone profits from that. Welcome to MacroScale, the truth behind the money. Most people assume that money exists because governments print it, that somewhere deep inside a fortified vault, there are piles of gold or physical reserves backing every dollar in circulation. That idea is a myth, a comfortable, persistent myth that the modern financial system quietly abandoned over 50 years ago. In 1971, President Richard Nixon ended the direct convertibility of the US dollar to gold, an event known as the Nixon shock. From that moment forward, the dollar became what economists call a fiat currency, money backed not by a physical commodity, but purely by government decree and collective trust. There is no gold in Fort Knox sufficient to redeem every dollar circulating today. There is no vault large enough. What backs your money is nothing more, and nothing less, than the shared belief that it has value. Here is the fact that most economics textbooks gloss over. Commercial banks, the ones on your street corner, do not lend out money that depositors put in. They create new money from nothing every single time they issue a loan. This process is called credit creation, and it is the dominant mechanism by which money enters the modern economy. When you walk into a bank and take out a $100,000 mortgage, the bank does not reach into a reserve drawer and hand you existing cash. It types a number into a computer. Your account balance increases by $100,000. Money that did not exist 60 seconds earlier. Simultaneously, the bank records your mortgage as an asset on its books. The debt you owe becomes their asset. The Bank of England confirmed this process in a landmark 2014 paper, stating directly, and I quote, "Banks do not act simply as intermediaries, lending out deposits that savers place with them. The reality of how money is created today differs from the description found in some economics textbooks. Your loan is the money, and when you repay it, that money is destroyed." If commercial banks create money through lending, what controls how much they can create? The answer lies with the central bank. In the United States, the Federal Reserve. The Fed operates at the top of a layered system. It issues what is called base money, or reserves, the foundational layer of the monetary system used only between banks and the central bank itself. Commercial banks can then use these reserves as the foundation for creating far larger amounts of credit money through lending. This was traditionally explained by the money multiplier theory. If a bank holds 10% in reserve, it can lend out 90%, which gets deposited elsewhere and lent out again, theoretically multiplying the initial reserve tenfold. But here is the critical update. Economists and the Fed itself have largely abandoned the strict money multiplier model. In reality, banks lend first and find reserves later. The Fed accommodates demand for reserves after the fact to maintain its interest rate target. In 2020, the Federal Reserve eliminated reserve requirements entirely for most deposit accounts, officially confirming that the textbook model was, at best, a simplification. What actually constrains lending is not reserve ratios. It is capital requirements, profitability, and the willingness of borrowers to take on debt. Every time money is created, whether by a central bank expanding its balance sheet or a commercial bank issuing a loan, the total supply of money in the economy grows. And here is where the hidden cost arrives. When the money supply grows faster than the production of real goods and services, each unit of currency buys less. This is inflation, not merely rising prices, but the dilution of purchasing power across every dollar already in existence. Between 2020 and 2022, the US money supply measured as M2, increased by approximately 40% in just 2 years, the most dramatic expansion in modern American history. The Federal Reserve injected trillions into the financial system to combat the economic fallout of COVID-19. By 2022, inflation in the United States hit a 40-year high of 9.1% in June. Ordinary people, those without significant assets in stocks or real estate, watch their savings quietly erode. The wealthy, whose net worth is tied to assets that inflate alongside the money supply, largely preserved and even grew their wealth. This is the mechanism critics call the Cantillon effect, named after 18th century economist Richard Cantillon, who first observed that those closest to the source of new money, governments, banks, large financial institutions, benefit first before prices adjust. Those farthest from the source, wage earners, savers, retirees, absorb the cost last and lose the most. So let us bring this full circle. Money in the modern world is not found, it is created. It is created by central banks when they expand their balance sheets. It is created by commercial banks every time they issue a loan. It evaporates when debts are repaid. It loses value when created in excess of real economic output. The system is not random, it is structural. And it has been designed, modified, and defended by some of the most powerful institutions in human history, precisely because controlling the creation of money is, in the most literal sense, the control of economic reality itself. Understanding this does not make you powerless, it makes you literate. Financial literacy is not about budgeting apps and saving tips. It is about understanding the architecture of the system you live inside. When you understand that inflation is a structural feature, not a bug, that debt is the engine of money creation, that purchasing power is silently taxed every time a new dollar is born, you begin to make different decisions. You ask different questions. You build differently. The first step is always the same. Understand the rules of the game before you play it. If this video gave you a new lens to see the world through, subscribe to MacroScale for more breakdowns that go beyond the surface. And share this with someone who thinks money still comes from a vault. See you next time.